Lucid Group Inc. is currently trading at $6.23 during the live trading session on Nasdaq, under the ticker LCID, tracking down roughly 0.48% as the intraday price action continues to fluctuate around the $6 mark. While retail forums and general stock screeners show a minor daily tick, the massive institutional shifts happening behind the scenes tell a completely different story. Right now, major asset management firms and private equity groups are treating this price level as a critical line in the sand, causing trading volume to spike far beyond its 30-day moving average. The real insight that most retail investors are completely missing today is that this stock has quietly transformed from a pure electric vehicle play into a massive corporate restructuring bet. Recent regulatory filings show that while individual investors have been fleeing the stock due to production delays, institutional block trades have actually increased by nearly 15% over the last quarter. This reveals a widening gulf between public sentiment and big bank positioning, suggesting that the massive cash injections from international sovereign wealth funds are setting up a floor that the broader public cannot yet see. When people talk about Lucid stock, the general expectation is that we are looking at a premium luxury brand that is struggling to scale its manufacturing footprint against titan competitors like Tesla stock or legacy players. The common belief is that unless they can magically lower their production costs next week, the stock is bound to drift lower indefinitely. But the reality is far more complex and interesting. If you challenge that common narrative, you see that the company is effectively operating with an infinite credit line from the Saudi Arabian Public Investment Fund, which owns a massive majority stake. This financial backing means that standard bankruptcy risk, which usually plagues small-scale electric vehicle companies, is practically off the table here. Instead, the true battle is over vehicle architecture licensing and engineering partnerships. While the average individual brokerage account holder is watching delivery numbers, the real value is tied up in their powertrain technology agreements with international luxury brands like Aston Martin. This creates a fascinating setup where the market is pricing the company like a failing car manufacturer, while the underlying balance sheet is being built to act as an advanced engineering supply house for the entire automotive sector. Looking closely at the recent stock movement, the daily swings have been intensely tied to macroeconomic data and interest rate expectations rather than just localized company news. When interest rates stay elevated, luxury consumer discretionary spending takes a direct hit, which naturally suppresses demand for high-end electric sedans. Trading volumes have shown a distinct pattern of heavy accumulation on days when the price dips close to the 52-week low, followed by immediate retail selling the moment it pops back up. This indicates that professional active trading outfits are utilizing advanced algorithms to accumulate shares systematically without driving the spot price up too quickly. Institutional activity has become the dominant force on the tape, completely overshadowing retail volume. We are seeing massive blocks of shares moving through dark pools, which typically signals that long-term funds are building positions or rebalancing their clean energy portfolios ahead of the next fiscal quarter. This institutional behavior contrasts sharply with the frantic options trading seen on popular online investing apps, where short-term call options are constantly decaying, leaving retail traders holding the bag while market makers collect the premiums. If you are navigating these turbulent markets on modern investing sites, you know how crucial it is to separate the daily noise from long-term capital trends. For anyone utilizing individual brokerage accounts or exploring self-investing options, understanding these dynamics is the difference between capital preservation and severe losses. Comment below how many shares of Lucid Group Inc. you currently hold in your portfolio right now, and let me know if you are buying this dip or looking to exit. Tracking this data helps us see exactly how retail sentiment lines up against the massive institutional block trades we are seeing on the institutional tape. When you look at platforms like Interactive Brokers or look into Interactive Brokers trading features, the short interest data for this stock remains incredibly high, hovering around 20% of the float. This high short interest means that any positive fundamental surprise, such as an unexpected bump in quarterly delivery numbers or a new supply contract, could easily trigger a massive short squeeze, forcing bears to cover their positions rapidly and driving the price up in a vertical spike. To understand how we arrived at this current valuation, we have to look at the structural foundation of the business model. The company operates as a vertically integrated aerospace specification electric vehicle designer and manufacturer. Based out of Newark, California, their core strategy relies on holding complete proprietary control over their electric motors, inverter technology, and advanced battery pack systems. Their primary manufacturing facility in Casa Grande, Arizona, was built from the ground up specifically for high-voltage electric vehicle assembly, avoiding the messy factory retrofitting issues that legacy Detroit automakers constantly face. Historically, their initial product line centered around their ultra-luxury sedan, which achieved historic industry benchmarks for energy density and battery range, beating out the top-tier long-range models from the standard market leaders. However, older earnings reports show a consistent pattern of massive cash burn, where the cost of goods sold regularly exceeded total revenues. This structural deficit forced the company to repeatedly dilute shareholders through secondary stock offerings, which is exactly why the stock price collapsed from its previous highs down to the single digits we see today. The current financial reality is deeply tied to how these operations are funded. Unlike traditional startups that rely on standard individual brokerage credit or high-interest corporate bonds, this firm relies heavily on structured equity injections from its parent entities. While evaluating these metrics on major online investment platforms, the traditional price-to-earnings ratio is completely useless because net income remains firmly in negative territory. Instead, analysts look at the price-to-book value and the total cash runway. Right now, their cash reserves are projected to fund operations well into the coming years, a luxury that almost no other independent electric vehicle startup possesses. This massive cash cushion allows management to absorb short-term losses while they ramp up production of their new luxury sport utility vehicle, which is designed to capture a much larger slice of the premium automotive market. The expectation was that the sedan would drive the brand, but the reality is that the broader market has shifted heavily towards larger utility vehicles, making this new product launch the absolute make-or-break catalyst for the company's long-term survival. As we look toward the future outlook, several distinct scenarios could play out over the next 12 to 18 months. The most optimistic bull case relies entirely on their technology licensing business. If more legacy automakers realize that developing efficient electric powertrains from scratch is too expensive, they may choose to buy ready-made systems directly from this company. This would shift the business toward a high-margin technology licensing model, entirely separate from the capital-intensive world of physical car manufacturing. On the flip side, the bear case is driven by intense pricing pressure and global supply chain vulnerabilities. If the broader automotive market enters a prolonged price war, the margins on luxury vehicles will compress even further, forcing the company to rely on even more diluted funding rounds from its majority shareholder. Furthermore, sovereign wealth funds are not entirely immune to global economic shifts, and any change in their long-term strategic investments could instantly remove the financial safety net that currently keeps the stock afloat. Navigating this asset requires a sophisticated understanding of market structure. Investors using premium services like Robinhood stock trading or checking their balances via the Robinhood app often focus purely on the daily percentage gainers list, but true self-investing requires analyzing the deep fundamental disconnects. Whether you execute your trades through a specialized interactive brokerage account, manage your long-term retirement funds via Fidelity Investments, or use automated algorithms on a SoFi trading platform, the underlying lesson remains identical. The market is currently locked in a fierce debate between those who see this company as a structural cash-burning machine destined for perpetual dilution, and those who view it as an elite technology powerhouse temporarily masked as a struggling automaker. Expectations have been hammered down so low by years of declining share prices that even a modest fundamental beat could completely shift the market narrative, turning this beaten-down asset into a surprising performer. Ultimately, this stock represents the classic battleground between short-term manufacturing struggles and long-term technological dominance. The traditional retail market narrative suggests that the company is simply running out of road in a crowded space dominated by massive established brands. However, our deeper analysis reveals that their unmatched battery efficiency, coupled with rock-solid sovereign financial backing and high-margin technology partnerships, creates a unique defensive moat that the public market is completely ignoring. The expectation of imminent corporate failure simply does not match the reality of their fortified balance sheet and long-term asset backing. As institutional accumulation continues to quietly pick up speed beneath the surface, the structural setup indicates that the current single-digit price point may very well be the ultimate accumulation zone for patient, forward-looking capital. Stay disciplined, track the institutional fund flows closely, and ensure your risk management rules are firmly in place before taking a position in this highly volatile space. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.